Morning, everyone. Welcome to you all, and thank you very much indeed for giving up your time to join us this morning. Alongside me, I have Chris Lewis and Nick Georgiadis, investment directors at Cazenove Capital Management. Chris will be delivering the webinar, and Nick will be running the Q&A session at the end. You should see a Q&A box on your screen. Please, would you type your questions as you think of them into the box, and then Nick will pick them up in due course. So far, 2022 has seen a flood of bad news, including the Ukraine invasion, skyrocketing energy prices, and most recently the UK gilt crisis, which is causing a spike in mortgage rates, and sterling is now behaving as a consequence, a bit like an emerging market currency. The aim of today's webinar is to provide an insight into the key themes that we think business owners need to have a grasp of as we head into what is likely to be a very challenging trading period in 2023. I will now hand you over to Chris, who has prepared some excellent slides, which I hope you will find both informative and interesting. Over to you, Chris. Thank you.
Thank you, Peter. Good morning, everybody. So as Peter mentioned, I've put together a few slides this morning, mostly focused on the economic outlook. There are obviously some more investment focused and investment strategy focused slides in here as well, given the impact that we have clearly seen on investment markets this year. So to begin with, I thought it was useful to look back over what has been another very volatile quarter for financial markets and the UK economy, and just see what we thought were the key themes for this period. So as we know, for much of the year, for the first half of the year in particular, a lot of the volatility in markets was driven by higher inflation as a result of the Ukraine-Russia war, and the expectation that the central banks would have to react to this by raising interest rates, which we saw pretty aggressively in the US. Now, as we came into the third quarter, there was a far more positive mood at the start of the quarter, at least. Firstly, we did have a robust earnings season across both the US and Europe. It exceeded expectations, and that helped to calm investor nerves. Secondly, we also saw a slight rotation in opinion, where, as I said, the first half of the year was all about rising interest rates and the impact that could have on markets. The feeling was in sort of between mid-June and mid-August that potentially we had seen peak inflation, particularly in the US. And also, it was a kind of a case that bad news was actually turning out to be good news. So we saw the second negative GDP print in the US. And the feeling was that if the Federal Reserve could step back from focusing on inflation, because inflation was starting to fall, and therefore they could start to potentially cut rates to help support economic growth. And that would be good for the economy, but also good for financial markets. It would help either avoid a recession or at least have a soft landing, as it's called, where we don't see a very deep recession. And there's a lot more positivity in markets around that. Now, sadly, as you can see from that chart, that positive sentiment didn't last very long. We got us to about early August before we started seeing, again, the Federal Reserve coming out with messaging saying, actually, inflation does remain very elevated. They are very focused on ensuring that inflation does fall down to their target level of 2%, and they will do whatever it takes in order to achieve that goal. So the market, again, quickly changed its mind. They were no longer in the thinking that we were going to see a near-term pivot in policy, and actually interest rates were going to move higher until we saw inflation fall back to manageable levels. So that was, again, the Federal Reserve Jackson Hole meeting, which is their sort of annual conference. That was the key message out of that meeting, which again unsettled investors to a certain degree, followed soon after by surprisingly strong US CPI print, proving that inflation in the US is indeed quite persistent, which resulted in the third successive 75 basis point rate hike, interest rate hike by the Federal Reserve, which is the most they've ever done in history. So it was ends up being another volatile period for financial markets. Now, this chart here shows interest rate expectation in 12 months' time across the US in dark blue, the UK in light blue, and the Eurozone in purple. You can see broadly where we've moved from August 2021, we've moved significantly higher, and you see that slight dip down before a sharp reversal. That was, again, that illustrates the realization that inflation does remain a problem, that interest rates have to move higher. The UK has seen a significant move higher, and I will talk about that more in a bit more detail. But I think from an investment perspective, this rotation and this expectation of higher interest rates in a year's time has really been a key driver of asset class returns this year. It's impacted both bond markets and equity markets equally. So if we look at how those two markets have performed this year, you can see from this chart the correlation has been incredibly high between bonds and equities. And from an investment perspective, this has been a real challenge. If you look back on this chart, you look back over time, back to 1980, and if I could have done this chart back to the 1800s really, and it would have been a very similar pattern, that in periods of equity market volatility, when periods when equity markets are significantly down, we have tended to see bond markets offer some diversification and protect capital. So in essence, you could create a portfolio of about 50% bonds and 50% equity to help dampen that volatility. As you can see, that has not been the case this year. It has been an incredibly tough year for investors, particularly those who are focused on traditional asset classes. From where we are from an investment strategy perspective, we have tended to we have favored alternative assets this year as a result of this. So we have been underweight fixed income, and we've allocated far more to the likes of commodities, to gold, to absolute return funds as a means of delivering better diversification in this inflationary environment. And that has worked incredibly well for us throughout the course of this year. And this chart just shows the performance in sterling terms of some of those assets relative to UK gilts, which is the yellow line at the bottom, as the alternative source of diversification. Now, we clearly can't talk about the third quarter of themes for the third quarter without mentioning what went on in UK gilt markets and UK politics in particular. And we saw, and the key event was clearly the mini budget, as it's called. It wasn't really very mini in reality, but what was referred to as the mini budget, and the remarkable reaction from gilt markets and UK assets in general to this announcement. So I'm sure a lot of people have read a lot about this already, but a quick summary of why we saw so much volatility. I think in particular in gilt markets, and this chart here shows the reaction of the 30-year gilt yield. The concern was effectively threefold. It was a recognition that the biggest package of tax cuts since 1972, effectively handing the consumer 300 billion in total, was going to be inflationary in nature at a time when inflation was already running at close to 9%. Therefore, in response to that, the thinking was that interest rates would have to rise faster and further than had previously been expected, which was reflected in higher bond yields. Secondly, and I think this is a really important point, it is the fact that there was a decreasing credibility of both the government and the Bank of England. Investors just didn't believe or didn't understand how, and I think this is still the case, they still don't understand how the government are going to fund the package of fiscal handouts without hugely increasing national debt, which had an implication for sterling, which I'll talk about in a bit. So I think the credibility of the government was a real issue. And so people effectively don't want to own UK assets at this stage. We've seen large-scale selling of gilts as a result of this, and there's very few buyers of these assets on the other side. And this again was reflected in LDI schemes, so liability-driven investment schemes, these schemes are used a lot by pension schemes. They look to match the assets of a pension scheme to its liabilities. And historically, they tended to do this by owning a lot of long-dated gilts, which have set cash flows, which they can use to match these liabilities. However, over the last 10 years, when we've seen returns from gilts being so low, we've seen these schemes increasingly using swaps as a way of delivering it. So effectively, they are buying a fixed interest, a fixed flow of income from investment banks on one side, and they're selling back to them a floating rate line of income. So what this means, it works incredibly well when yields have been falling for the last 10 years, because effectively they're getting a fixed income stream and not having to pay a huge amount for it. However, when yields spike up hugely, it means that what they have to pay back, the cost of paying back increases. And as we saw, they were struggling to meet these payments in a timely fashion. They were having to sell gilts in order to do that, which again added to the selling pressure and led yields to be much higher. And the impact of the LDI schemes in particular was so large, and the concern in the Bank of England was that they were unable to sell enough gilts in a timely fashion, and it was causing quite a disorderly market environment that effectively the Bank of England had to step in. And we saw them step in a couple of weeks ago, committing to buying up to 65 billion of long-dated gilts. I think the important point with this, and again, it's more recently, it's resulted in further market volatility. The aim of the Bank of England was simply to ensure that the market behaved in an orderly fashion and that there was ample liquidity for pension schemes, so we didn't see a massive blow up of the pension system. They were not trying to support asset prices. It wasn't the same as QE. It was simply to try and ensure that we didn't see that we maintained orderly market conditions. And again, more recently, they have again reiterated this. They've said that they are going to stop the bond purchasing program tomorrow on Friday, which is tomorrow. So they are going to stop the bond program tomorrow. And as a result, we've seen bond yields rise again because investors are concerned. Again, they don't have credibility in the government. They're concerned that without the Bank of England support, there is going to be a serious issue in the UK gilt market. So I think this story is far from over. We're likely to see significantly more volatility over the weeks to come. For me, the key signpost to look for is the 31st of October. It is when the Chancellor comes out with his plan of how he wants to fund the 300 billion of fiscal package, and if that is seen as credible by the market, then I think we'll see things calm down quite a bit. At this stage, they've obviously ruled out cuts to public spending. So without rolling back some of the planned tax handouts, I struggle to see how they're going to achieve this. So it's going to be interesting. I think it's going to be quite an important date for the market to focus on. Up to that point, I can see gilt markets and UK assets being very volatile and continue to be quite volatile. Now, clearly, and sorry, I'm spending a lot of time on this because I think it is a really important point, and it's going to shape both the UK economic outlook and market outlook for the next couple of months. The second point around this, as we saw sterling reacted very badly to this news. I think we saw sterling hit briefly all-time lows against the dollar before slightly recovering, and now we're back into that broader downward trend that we've seen for most of this year, about 110 against the dollar. The reasons we've seen weakness, particularly against the dollar, are twofold. Well, there are several reasons really. So firstly, again, concerns over growing the fiscal deficit. So the fact that the government were looking to deliver this $300 billion or £300 billion fiscal handout, again, concerns about how they'll be funding that without hugely increasing government debt. Secondly, growing the current account deficit. We know this year in particular, it's been very difficult trading conditions where we import a lot of our energy at a time when energy prices are hugely increasing. And that has been, again, making our current account deficit look far worse. The challenging inflation outlook and also the challenging growth outlook of the UK as a result of both our exposure to the Russia-Ukraine crisis and also the inflationary impacts of the mini budget. So again, the credibility and confidence in the UK economy is low, confidence in the government to manage its debt levels are low. And so effectively, why would people want to own sterling at this time, particularly against dollar? And I think, again, the dollar this year has also been a really strong story of dollar strength as well as sterling weakness. Now, the dollar does remain the global reserve currency. We know that investor sentiment has been tested. We know that it is likely, very likely, we will move into recession in the US and the UK next year. So at a time when investor sentiment is weak, people tend to want to own safe haven assets, of which the dollar is one. Secondly, near-term interest rate differential has been quite big. As I've mentioned, the Federal Reserve have been quite aggressive in raising interest rates quickly in order to deal with the inflationary problem. At the same time, the Bank of England have not met the inflation picture with this at the same pace. We know that we haven't seen the same size of interest rate increases from the Bank of England yet. So that has led to quite a large interest rate differential. So again, people want to own the dollar relative to sterling. Now, the question, I suppose, is where do we go from here? We know where we are. We know the reasons we're here. What is going to change, and where do we see sterling moving from here? I think at this stage, The interest rate story may change slightly. I would fully expect the Bank of England to raise rates aggressively in both November and December of this year. We saw Hugh Pill, who's the Bank of England chief economist, mention yesterday that they expect quite a robust response to the economic outlook. I would expect probably at least a 75 basis point rise in November and December, if not more. The market is pricing in a further 2% of increase by the end of the year in terms of UK interest rates. So that interest rate differential will close. What's unlikely to change in the short term, I think, is the demand for dollar as a safe haven asset and concerns over sterling, given the debt profile and its status as a more risky currency. So until we see a resolution to some of the economic concerns more globally, or a resolution to the geopolitical tension that we have in Europe in particular, I think the dollar could remain quite strong against sterling, and so on the flip side, sterling could remain weak versus the dollar. So at this stage, we're very happy to remain our overweight position in the dollar relative to sterling. I wouldn't be surprised if we were testing at least the lows that we saw in September, if not parity, at some point before the end of the year. So it's not a hugely positive story on the sterling versus dollar. It's worth mentioning that obviously that's just one currency pair. It's a very different story if you look at sterling versus euro. This year, or this is the last 5 years really, you can see actually, I mean, we have weakened marginally against the euro in 2022, but it's not significant compared to where we've been over the past 5 years. And if I included a bit further back, you'd have seen the sell-off around Brexit, which was much more significant for sterling. But effectively, I think both the UK and Europe are facing similar economic challenges. They have been moving at a similar pace in terms of the interest rate rises. So the characteristics of the currencies, characteristics of the economies are relatively comparable, which is why you probably haven't seen the currency react so significantly. So as I mentioned, it has been as much about the dollar strength as it has been about sterling weakness this year. So in terms of our outlook and where we think we're going into the end of this year and into 2023, and broadly, I would say the economic themes are going to be very similar. I think concerns around persistent inflation against the backdrop of slowing economic growth are going to continue to dominate economists and investors alike. Sentiment is likely to be very weak. I think a lot of focus will remain on what the central banks are going to be doing and how they're going to respond to inflation. And a lot of focus will be on economic data. If we continue to see inflation print at current levels, I don't expect it to move higher necessarily, but if we continue to see inflation print at current levels, I would expect investors to continue to be quite concerned around further interest rate hikes. I also think the situation in the risks around Russia and Ukraine are still very much real. We know that they are escalating, if anything, and that could again continue to test consumer or investor sentiment, particularly the impacts it's having on the energy markets. From an investment perspective, and there aren't many positives to talk about at the moment, but I suppose a relatively more positive story is the fact that valuations, as a result of the sell-off we've seen across markets this year, do look better. So equity valuations have moderated, although I would say that earnings are a significant risk to that story. And again, government bonds and other areas of fixed income do look better value. So for long-term investors, there do appear to be pockets of opportunity to start to build exposure, although we remain quite cautious on that front. So looking at US inflation to begin with, and what's been really interesting, and this chart here shows obviously headline inflation in the blue line and how it's changed since January of last year, but also in the bubbles. These are all quotes from Jerome Powell, who's the chair of the Federal Reserve. And I think the response or how the US policymakers are choosing to view inflation has shifted quite significantly. So moving back to January of last year, it was all very much about, inflation is transitory. It's all about supply chain disruption. There's nothing really to be concerned about. As soon as COVID is over and supply chain issues disappear, then inflation will drop back to our target. In fact, it's probably a good thing. We've been trying to generate inflation around our target for a long time, so this is helpful. Move forward to January of this year, I think the picture has clearly changed a lot. The transitory inflation word had been abandoned, and the narrative was shifting quite significantly towards inflation being much more persistent and much more of a challenge. And fast forward again to August this year, and as I mentioned, we had the Federal Conference at Jackson Hole. And again, it was a very clear message that this is the singular purpose of the Federal Reserve at this stage, is to tackle inflation, is to ensure that we return inflation to our long-term target, and we will do whatever we can in order to achieve that. So that has been a significant shift in response to inflation over that period. So where we are today, I think in the US, I would say we have seen peak inflation, and I think unless we see another significant development in the Russia-Ukraine war, nuclear weapons, etc., which I don't really want to talk about. In the absence of that, I would say inflation has peaked in the US in particular, although as we can see, it does remain persistently high. And I think I've put on the right-hand side of this chart, I've put measures of the Atlanta Fed. They measure sticky inflation. So it's effectively both wages and property are the two key components of this. And it's areas of the inflation print which take far longer to work out the system and can therefore lead to a more persistent or longer term inflation problem. And as we can see from that chart, actually the sticky elements are the highest they've been since the mid 1980s. So inflation does remain an issue. The Fed are very, very focused on this, and it's going to continue to dominate their discussions, at least for the next couple of months. In the UK, the inflation story is very similar. We're more exposed to, on the energy front, we're more exposed to the Russia-Ukraine crisis. So we do have great exposure there. However, following the introduction of the energy price cap, I do think the picture has slightly changed. So in this chart shows the forecast of inflation from our economists out to 2024. In blue, it was before the introduction of the price cap, and in purple, it is following the price cap. So you can see in the short term, it has reduced our expectation of inflation. We may not see inflation move much higher from where we are today. However, as I mentioned, the fact that both the energy price cap as well as the mini budget effectively constitute a significant handout to the consumer, to the UK consumer, we could see that boost demand. We could see energy inflationary pressures being replaced with consumer-driven domestic inflation pressures. So inflation, again, could prove to be more persistent in the UK. And you can see that from the shape of these lines, right? So the purple line out to October 2024 does remain at around 6 to 7%. Which is obviously significantly higher than the Bank of England target, and will continue to pose a challenge to both households and to businesses for a longer period of time. So what does this mean for interest rates? I think it's pretty obvious. I think the communication from central banks and from markets generally has been pretty clear that whilst this year we have already seen interest rates move significantly higher in response to inflation, which is what this chart illustrates. It shows the small flags where we were in January, and the larger flags is where we were in various countries at the end of September. I think this picture for the UK in particular, we can expect interest rates to move significantly higher by year end. As I mentioned, I wouldn't be surprised if we saw 1% interest rate hikes, and that is certainly what the market is pricing in. The US, I think the picture is slightly more positive, I'd say. Obviously, they've moved far more aggressively sooner than we have seen in other central banks. So they've done they've front loaded a lot of the work. And that means I still expect the Federal Reserve to hike in November by, I wouldn't be surprised again if it's 75 basis points. In December and February, they will still raise rates, but probably by a smaller amount. I think that from an equity market and from a broader economic perspective, once we see the pace of increases start to slow, once we see the language around the policy start to change, that will be a more positive signal from a global economic perspective that actually we may be through most of the pain. But until we get to that point, and assuming we don't see a big change in the inflation picture, I think we're still very much in this case of interest rates are moving higher in response to higher inflation. Another key story of this year, very much related to inflation clearly, and one that will continue is the European energy crisis. The chart on the left just shows natural gas futures prices. You can see they spiked up hugely in August. They have settled down, although I would say that the story is far from over. We know that obviously Russia are effectively using the supply of gas as their key weapon to continue to further their aim in this war. They know that they've effectively got Europe over a barrel at this stage. A lot of, no pun intended, they've got a lot of reliance on import of both oil and gas from Russia. At the same time, we've also now seen OPEC cut production as a way of trying to manage the price, which is hugely unhelpful at a time when a lot of countries are already struggling with elevated energy prices. So I think moving into the end of the year, particularly as we're now moving into the winter months when demand for heating, demand for oil and gas is going to increase in the Northern Hemisphere in particular, against a continued backdrop of constrained supply, I wouldn't be surprised to see both oil, gas, and by extension petrol and diesel move higher back to where we were earlier in the year, sadly. And this is, it's bound to have huge implications for households across both, particularly across Europe. And this chart here from Goldman Sachs just shows the potential implication on disposable income of current energy prices across Europe. So historically, we've tended to see about 7 or 8% of disposable income being used to heat houses or being used to pay energy bills. This year, it's estimated it will broadly double to 15% before moving even higher in 2023 to around close to a quarter of households' disposable income. So it is a big challenge, and it's one that could have significant implications for the economy as a result. And I've put this chart in because I think it's quite interesting, and it just shows that gas is going to remain, or natural gas is going to remain, quite an important focus for markets for longer than the next couple of months or even a year. And that's if you tie in what we're trying to achieve, or what the Eurozone and global leaders are trying to achieve on climate change and the net zero commitments, then we know that eventually they want to reduce the use of fossil fuels, they want to reduce the use of natural gas in heating. But to get there, there has to be a clear path of transition. And the first stage of that is weaning ourselves off using fossil fuels, coal and oil, moving towards gas before effectively moving towards renewable energy. We don't yet have enough renewable energy supplies to allow that to straight transition. So there will be the first step towards using more gas in the short term. And that's reflected in, you can see, even under net zero, and assuming we do achieve net zero targets, the green line on the right-hand chart, you can see that the demand for liquid natural gas does continue to increase out to 2030. So again, this is going to potentially remain quite an important area and potentially quite an important driver of future inflation and implications for regional economies going forward. Now, away from inflation and looking more at economic growth, and again, I think these charts are for the UK. It's a very similar story for a lot of other developed markets, but as we know, consumer sentiment is incredibly weak at this stage. The outlook for both personal finances and broader confidence is close to all-time lows in the UK and the US. People are very concerned around, including if you combine higher energy prices with rocketing mortgage costs, then it doesn't look great for personal finances over the next year in particular. So what are people doing? They're already trying to reduce home energy consumption. They're already spending less on going out, spending less on buying new clothes, and trying to buy cheaper food products rather than going to Aldi rather than Waitrose, for example. So there is already people making sacrifice, and I think this is going to become more of a feature. We haven't yet seen that reflected in corporate earnings forecasts, and I think they do look far too optimistic. I wouldn't be surprised if we start over the next couple of quarters seeing a more significant reflection of these challenges in corporate numbers. On a related note, business confidence is also very weak. Obviously, we know businesses are in a very similar situation. And I've put the US on the left and the UK, so the CFO survey on the right. And what's quite interesting is, I think, particularly for domestic small and mid-cap UK companies, around 75% of them with debt, all their debt is floating rate. So, and another 10% have around about a 2-year fixed term on their debt. So a lot of companies are heavily exposed to what's going on with UK interest rates and obviously the UK gilt market at this time. And I think borrowing and conditions are going to become incredibly hard for UK companies in the short term. This is bound to impact margins. It's going to have an impact on profitability. And again, this is one of the reasons why I think from a growth aspect, if we look at our forecast for growth, we do think that the recession is now our base case for the UK, for the US in particular, and for Europe moving into next year. So higher inflation, weaker consumer confidence, weak business confidence will impact margins, will impact profitability, will impact economic activity. And that doesn't lead to a very nice recipe for the global growth outlook, I'm afraid, at this stage. So in terms of our investment views, what does this mean? I think at this stage, so at the start of this year, we were significantly overweight equity. It was a position we'd held for the previous 2 years, it had done very well for us. Throughout the course of this year, we've significantly brought down our equity weighting, and I'd now say we are the most underweight equity we have been relative to our neutral position for the past decade. So we're underweight equity, and we're happy to be there in the short term. I think the next stage for us on that front is looking forward into 2023 at some point and working out when we feel the right time is to start to re-engage with risk assets and equity in particular. On the flip side, we've been adding more to fixed income, not to UK gilts. We still aren't happy to own UK gilts given the volatility we've seen in that market. But we have been adding to US Treasuries, where I think there's more visibility on the outlook for how the Federal Reserve are going to respond, and we have slightly more confidence in owning US government debt at this stage. And I'm hoping as inflation starts to moderate, they will start, government bonds will start to demonstrate some of the diversifying benefits that we have seen historically from them, which will help to protect some of our capital. We remain positive alternatives. We continue to like commodities. They have done exceptionally well. However, at this stage, given the ongoing concerns we have with Russia and Ukraine in particular, and the impact that might have on energy markets, owning those assets, underlying assets, be it energy in particular, could provide a good short-term hedge against those risks. And we continue to hold cash for optionality. I won't touch on the long-term themes there because we have a section on long-term themes. So it's, I thought, again, it's slightly more interesting rather than talking more about investment strategy, which if anyone wants to do, I'm very happy to do it another time. But I thought we'd look at some of the longer-term implications from quite a disruptive couple of years in the global economy. So I think it's fair to say that the recent events, and by recent, I mean really looking back to 2020, if you include COVID, the disruption that had, and more recently the geopolitical situation, they have accelerated a number of structural trends in the global economy, which in turn will give rise to investment opportunities. Chiefly amongst these, I think it's of quite interest to this group is the fact that we are seeing a shift away from globalization to potentially a more regional focus, or a de-globalization trend. And what's driven this? So I think looking back, and really since China joined the World Trade Organization in 2001, you saw a big focus on businesses on supply chain efficiency. So looking to outsource manufacturing to emerging markets where businesses could access cheaper labor and help to benefit margins that way. Fast forward to 2021 or 2022. We saw the huge disruption to supply chains from coronavirus and obviously the lockdowns associated with that. We've seen increasing political tensions with China and Western nations. And we've also actually seen the chart on the bottom. You can see it's no longer that cheap to outsource manufacturing to China. As clearly they're increasingly looking to position themselves as producer of more premium products rather than just cheap labor. So there has been a real shift over the past 20 years. And again, I think particularly the supply chain disruption of COVID has accelerated the focus of businesses away from supply chain efficiency towards supply chain resilience. So now a few quotes on the left, you can see that 75% of global companies are now increasingly focused on either reshoring or certainly bringing supply chains closer to home. So what's called nearshoring or friendshoring. And I think particularly in the US this year, we've seen a lot of companies move production chains from China back to Mexico. So far closer to home, probably cynically far more easy to control from a US perspective. And they feel that there's far better security around having your supply chains close to home. From an investment perspective, what does this mean? So we know that if you are looking to bring production back on shore, labor costs are going to be higher. That's a natural assumption. In the near term, that is going to potentially have impacts on your profit margins. Longer term, what it does mean, I think, is that we are likely to see far greater investment in automation. Chart on the left here shows the impact on an annual basis of a 10% reduction. And this whole chart is based on a case study of the fast food industry, which I think is quite a useful one to look at. But you see that the impact of a 10% reduction in fast food restaurant workforce in the UK results in just over $120,000 of increased profit per year. So there will be savings longer term and efficiency gains longer term from increasingly automating some tasks in the production process. And I think if you've been to any sort of fast food restaurant recently or any coffee shop, really, you've already seen digital ordering systems being delivered. We know we have digital delivery services and Deliveroo, etc. throughout COVID, proved to be very helpful for a lot of people. Not me, because I live in the middle of nowhere, so I was very bitter about not being able to use it. But if you lived in the city, then it was a great thing to have. So we've already started to see this process, but I think it will naturally accelerate. Another key theme that this year, I think, has shown, again, it's around security, but it's around security of energy supply rather than supply chains, particularly for Europe. We know the implications. We know the impacts of the Russia-Ukraine war. We know as we came into 2022, a lot of European nations had a huge reliance on Russia for their energy supply, and that has proven to be very costly and quite a risk going forward. We saw the introduction of the REPower EU initiative in March, which was agreed by a lot of European leaders, which effectively committed to investing a lot of money into ensuring future security of energy supplies. And when you're a country or a region who does not have a huge natural resource or availability of deep wells of oil or gas, this essentially means that you have to see greater investment in renewable energy. So with the REPower EU, effectively, we could see around 3.7 trillion euros of additional investment in both the generation of renewable power, but also the whole infrastructure around it and supply and storage of that power. And that does present, I think, a very interesting long-term investment opportunity. So out of all these disruptive periods, there always comes interesting investment opportunities for those willing to take the risk. And I think this is potentially one of them. So over the next decades, we know that the challenges that climate change is posing. We know the challenges that energy security is posing. And both of those factors suggests that renewable energy could be an interesting, or investment in renewable energy could be an interesting long-term theme. Another key theme, I think, again, which is, it's kind of spanned the last couple of years, but it's been, and it's tied to defense. I think cybersecurity has been a really a growing and an interesting theme for us. So back to 2020, when we're all at home, locked down, living our lives through our computers, be it through work and also socially as well, the opportunity for cybercrime understandably increased hugely. So you can see on the chart on the right, the number of global cyber attacks per week increased from 17 million in 2018 to about 300 million in 2020. So it was rich pickings for the hackers out there. And that from our personal lives and our business lives, it became clear that the greater investment was needed in ensuring our security online. Fast forward to 2022, 2021, and we've seen obviously the Russian invasion of Ukraine, and one feature of that war has been the increased use of cyber attacks in warfare. And I thought this chart on the left was quite interesting, and they're all cyber attacks detected by Microsoft in 2021. Close to 60% of them originated from Russia. And again, this year, the Russia use of hacking, of cyber attacks in the invasion of Ukraine has been quite a key feature. So I think it's just really highlighted the fact that cybersecurity, both domestically in our work life, our home life, but also increasingly in warfare, is going to be quite a key feature of our futures. And also from an investment perspective, one of the features of this is hackers, and hackers tend to be ahead of the curve when it comes to the methods they're using. So it's going to be a constant requirement for additional investment in this space, which again could lead to quite interesting opportunities. And finally, another theme, and it's one we're all very aware of, but it's in continued technological disruption. As I mentioned, we are increasingly living our lives online. Businesses are increasingly moving to the cloud. We are in what is increasingly called now the fourth industrial revolution, which is potentially going to change the way businesses work and businesses function, and drive sort of the profit outlook for different companies. I think the cloud or cloud spending or moving your businesses on digitally is chief amongst this. We've seen it already, an increasing number of companies looking to spend a huge amount on ensuring that they have the right digital presence. And this is only going to continue. It hugely increases both agility and adaptability of companies going forward. It allows less lumpy capex and a more focus on efficient operation. So I think it's another trend which we've identified, which we think is a very strong and powerful investment trend, which can benefit our returns over the next decade or so. And I believe you might be pleased to hear that is all I have today. So very happy now to pass over to questions. I might stop sharing my slides so we can.
Great, lovely. Thanks very much, Chris. And good morning, everybody. My name's Nick Georgiadis, and I'm portfolio manager responsible for looking after Peter's clients. So I'm going to fire a few questions at Chris. I think the Q&A box should be visible on your screen, so please do continue to ask questions. But Chris, just to begin with, just back on interest rates for a moment, do you have a view on where they're likely to peak perhaps in the UK and the US, the most important markets for us, and what they might settle at in the long term? Is it realistic to think that they might come all the way back down to target levels again?
I'll start with the UK because that's the most relevant. So the market is currently pricing in, and you saw a chart earlier, I think the market's pricing in a peak interest rate in the UK of about 5.8% in November of next year, which is obviously a long way from where we are today. That would suggest quite a significant number of hikes over the next 12 months. My view is, I'm not sure the Bank of England can feasibly get rates all the way to 6% without significant, and they know this, without significantly damaging the housing market. We've already seen mortgage rates significantly increase this year. If we were to see interest rates move to 6%, the mortgage market would obviously have to respond to that. I think the Bank of England are very aware of the impact that would have on the UK economy. And so I feel that we may not see UK rates move all the way to 6%. I wouldn't be surprised if we get to 4.5 in quite quick order, but it is a bigger question mark for me whether we see interest rates move all the way up there. The implication that will have is then on what does it mean for sterling. I think again, longer term, it's another reason why we're happy to remain underweight sterling, because it would mean effectively the Bank of England would be sacrificing sterling relative to other global currencies, and would be happy to see sterling weaken if it meant that they were protecting the economy. It also could mean that inflation would be slightly more persistently higher in the UK relative to other nations. So there will be obviously sacrifices to be made on one side, but I think the Bank of England would potentially not look to raise rates all the way to 6%, simply because they wouldn't want to see the size of the recession that it would cause.
And I suppose linked questions that you've already mentioned, the property markets. Do we have a view on the likely impact on both residential and commercial property markets over the next year or two?
I think, I mean, there's going to be, I think financing is going to be a massive concern in the commercial space. Again, we've already started to see a slowdown in the residential space, and I imagine that's going to hugely accelerate. Just anecdotally speaking to, I'm sure it's all the same. We'll be having a huge, if anyone has a mortgage, you've probably been having a large number of discussions with friends looking to remortgage at this stage, people realizing that actually it's going to be prohibitively expensive to try and move house. So I would expect activity residentially to slow down. Commercially, it's going to be far more challenging, and the profits and volume are probably going to slow. In terms of how we're positioned, and we do have some exposure within property, but we're still very much focused on specialist property. So it's care homes, it's potentially large storage sheds, which they tend to have sort of far more visible income streams, which tend to be slightly inflation linked. So the opportunity there still looks quite attractive. And actually, given the volatility we've seen, there's greater number of value opportunities in that space. So we do think, again, from an investment perspective, there are opportunities. You have to be selective, but certainly it's going to be a far more difficult operating environment for the lower quality area of the property market.
Okay, thank you. And switching to a question on company profits and therefore share price valuations, you mentioned that earnings forecasts look too optimistic. Does that mean that the share price valuations are potentially under threat, and that there therefore could be more downside in markets if these forecasts are revised?
Yeah, I think so. If you look at the US, currently the analysts are pricing in about a 9.2% earnings growth for the current year for 2022 for the S&P 500. For 2023, they're still forecasting a 7% earnings growth against a backdrop of probable recession and huge inflationary pressure on margins. Historically, in periods of recession back to 1970, on average, earnings have fallen about 15%. So if our base case is for recession next year, but the market is still pricing in a 7% increase, historically in recession there's been a 15% decrease, that would suggest that the analysts are still being far too optimistic. And that is our concern, because whilst valuations have come down, they are predicated on current earnings expectations as part of the formula. So if we see earnings start to be significantly downgraded over the next couple of quarters, which I wouldn't be surprised to see, then valuations start to look more expensive as a result of that dynamic. And that again brings into question the price people are willing to pay for equities or pay for companies. So yes, in short, I would fully expect to see earnings remain fully in focus. If we do see some weakness in earnings, it's likely to result in further volatility in equity markets.
And you mentioned the recession word there, and a question about recession then, and that is what our view of how severe recessions might be. And again, I suppose you don't know whether it's UK, US, and what implications that has for the way we manage portfolios.
In terms of the severity of a recession, I think it'll be a similar picture for Europe, US or UK. It's largely going to be determined by the future direction of central banks at this stage. I think the recession is bound to be policy-led. It has tended to be historically, but particularly this time around, it's going to be a result of the aggressive response from central banks moving interest rates higher, the knock-on impact that has to businesses and consumers. So that will be the cause of it. And so naturally, if we continue to see quite aggressive response from, say, the Federal Reserve, and they do move interest rates higher from here and further than the market is expecting, that will have a greater impact on economic activity, and the recession will be deeper. At this stage, as I said, we feel like we have a relatively good understanding of the direction of travel in the US. The recession isn't going to be comparable to 2008. It will be quite a significant recession, but it's not going to be on a par with 2020 or 2008 or 1929, etc. So that is one, I suppose, relative positive. But I think that the determining factor will continue to be monetary policy from here. In terms of how we manage money around that, again, it's interesting. I think obviously companies are very much, share prices are very much linked to the global economy. But as I mentioned, what's really been key in driving share prices is expectation of monetary policy. So I feel even if we get a recession next year, which is our base case now, if we start to see central banks pivot their policy or be less aggressive and start to talk about cutting rates before the recession, we could actually see equity markets rally into a recession, funnily enough, because we've seen obviously a lot of the correction already. So again, from managing money, we're likely to remain underweight equity, but it could be the case that we start to reduce the size of our underweights into a recession based around the direction of monetary policy. So I really think that is the key variable in a lot of things at this stage.
Switching to the outlook for energy and commodity prices, do we have a view on where these are likely to go from here? And you could include, I suppose you could include precious metals like gold in that as well. Yeah,
I mean, so we still like commodities as a whole. And obviously, commodities incorporates energy, industrial metals, and precious metals and agriculture, and the various components of that will respond differently to different economic outlooks. And I think energy for us, and that is an increasing part of the broader commodity market, and it is one area and it's a reason we continue to want to own commodities, is for that energy exposure, because we do think from an energy perspective there's very good chance, as I mentioned, that oil and gas prices continue to move higher given the ongoing geopolitical tensions and the disruption to supply chains at a time of increasing demand. So the outlook in that space, I think, could deteriorate And again, owning the underlying physical assets is a good way of hedging our portfolios against that. Industrial metals have tended to be more sensitive to economic growth, so we could see a little bit of weakness in that space, although longer term, again, we're very positive on industrial metals. Simply the demand picture around the requirement for industrial metals as part of the energy transition process is huge. So I think longer term, there will be a significant demand for industrial metals from that in particular. So that again, we probably want to increase our exposure over the medium term to that area. And then precious metals, it's been, I think gold in particular has been an area of frustration for a lot of investors this year. Gold's tended to perform well in inflation shock environments, which arguably we have seen, and also in weakening growth environments, which again is what we're increasingly seeing. And yet gold in dollar terms is down about 10% this year. So it has been frustrating. It's largely due to the relationship it has with real yields, which I won't bore you with today. But effectively in terms of our outlook, I still think we're happy to maintain some gold because we do, as a risk-off asset, as a perceived safe haven asset, it has the potential to do quite well if the growth outlook in particular deteriorates significantly from here.
Thank you. And finally, simple question, really. I think you've slightly touched on it, but with a long-term investment horizon, is this a good time to be investing cash yet?
Yeah, I'm not nailing my flag to the mast on this, but I think if you have a very long-term time horizon and you're starting from a position of being 100% cash, I would say it's not a bad time to be starting to allocate to areas of the market. Areas of the equity market I would focus on would continue to be large cap, higher quality, more defensive sectors, which, because it is going to be continue to be a challenging market environment. However, again, if you have a 20-year time horizon, given where valuations have seen, then yes, I would say it's not a bad time. I would potentially wait until the earnings season starts today in the US. As I said, you could see volatility around that. If you see some big volatility around this earnings season, then that could be a good opportunity to start to build exposure.
Great, lovely. Thank you very much, Chris. And with that, I'll hand back to Peter.
Super, thank you, Nick. Thank you, Chris. That was excellent. And I hope that all of you listening found that informative and helpful. The recording of this webinar will be posted to the events page of the Rycroft Glenton webinar shortly. So if any of you'd like to revisit any element of it or share it with any friends or contacts, please do forward on the link. And I think that just leaves me to wish you all a very productive day ahead. And thank you very much indeed for giving up your valuable time to join us. It is appreciated. So thank you very much and goodbye to everyone.
Thank you.
Thank you.